Hi, thank you for watching Digging to China. I'm Dong Xiong. If you have not done so already, please subscribe to my channel. Thank you very much. In comparison to the approach taken for the stock market, it is clear that the Chinese Communist Party is more actively involved in addressing the real estate sector. First-tier cities like Guangzhou and Shenzhen have recently embarked on urban village renovations with support from the central bank, introducing a housing ticket system. Following this trend, the second-tier cities have also received attention from the central bank. The People's Bank of China recently approved a 100 billion yuan housing rental group purchasing loan, backing 8 pilot cities in acquiring commercial housing for long-term rental purposes. These 8 pilot cities include Tianjin, Chengdu, Qingdao, Chongqing, Fuzhou, Changchun, Zhengzhou, and Jinan, all exclusively second-tier cities. In simpler terms, the central bank has allocated 100 billion yuan to the local governments of these 8 cities, enabling them to purchase commercial housing for long-term rental use. The policy loans offered by the central bank features remarkably low interest rate with a maximum of just 3% and an extended repayment period for up to 30 years. Consequently, if local governments can generate a rental return of over 3% on the purchased properties, the annual interest would suffice to cover the expenses, making the repayment of the principal amount unnecessary. Given the 30-year term, it can be seen as akin to a perpetual bond. What consequences might arise in the real estate market due to the central bank's policy? Will housing prices find stability, or is a further decline expected? How will local governments creatively utilizing their roles as landlords? Additionally, what potential risks are concealed behind the implementation of this policy? Initially, it's essential to grasp the rationale behind the central bank's introduction of this policy. Essentially, the central bank's mindset is straightforward, with its ultimate objective consistently centered on preventing systemic financial risks. The livelihood of the general public is not the primary concern. At the present, the real estate sector is still grappling with issues, primarily stemming from the difficulty real estate companies face in selling their properties. It's likely still fresh in everyone's memory that the central bank continuously urged the banks last year to treat all entities equally and provide loans to real estate companies as needed. However, banks had already become cautious about the real estate companies due to risk control measures. They were hesitant to invest further in the real estate sector. Faced with this situation, the central bank realized that mere appeals were ineffective, considering banks are not charitable institutions. So, what was the solution? Change the borrower. If banks were unwilling to lend to real estate companies, the alternative was to extend loans to local governments. With these loans, local governments could acquire unsold properties from real estate companies, leasing them out, generate rental income, and use that income to repay the loan interest. Following this train of thoughts, the central bank has introduced a dedicated leasing loan. When commercial banks borrow funds from the central bank, the associated cost is 1.75%. Following this, when the central bank extends loans to local governments, the interest rate can reach up to 3%, with a maximum repayment period of 30 years. The loan amount is capped at 80% of the assessed project value, resulting in an exceptionally high mortgage rate. It's clear that the central bank has conducted calculations based on rental yield, with 3% representing the rate at which the central bank believes local government should be able to achieve in terms of rental returns. The 30-year loan term implies that the central bank may not have intended for local governments to fully repay the principal amount. Let's explore how these 8 pilot cities might employ this loan. To obtain this loan, the initial step is certainly to identify a project. The local government's primary focus for acquisition would be the properties developed by its own investment platform companies. If you explore cities across China, you will likely find many developments by these city investment companies, which serve as financing platforms for local governments. When seeking this leasing loan from the central bank, these companies would be the entities involved. Thus, the first priority is to address the properties held by these companies. Now let's tackle the second question: how to go about acquiring these inventory properties and at what pricing strategy? Will it be based on market rates, cost price, or perhaps selling at a loss? This presents an opportunity for analysis. Let's delve into a hypothetical scenario. If City A's municipal investment company has limited inventory properties and it needs to procure houses from other developers, would they engage in tough negotiations, possibly driving a hard bargain? I believe they would. And there might even be dual contracts in play. The officially stated acquisition price may be one figure, but in practice, developers could find themselves returning a portion of the received funds. The purpose of these dual contracts is likely for loan deception. The funds returned by the developer could then be redirected by the local governments to settle debts, constituting the first situation. Another scenario unfolds in City B, where the municipal investment company holds a substantial inventory of properties. Over the past couple of years, City B strategically had its investment company acquire numerous plots at high prices to support land values. This has led to an overflow of properties in the possessions of City Investment Company, creating a challenge in selling them. In response, City B will spare no effort to assist its investment company in clearing the surplus inventory. They will seek as much funding from the bank as possible, aiming for a substantial amount. However, this approach comes with a drawback. Aside from the local government's investment company, other real estate developers receive no aid and may still face financial challenges. Now let's contemplate the impact of local governments transitioning into landlords on housing prices. Firstly, focusing on the rental market, the influx of properties into the hands of local governments for leasing purposes is bound to increase available housing stock. Consequently, this surge in supply is likely to exert downward pressure on rental prices. Considering the existing challenges in the job market, rental rates are expected to decline. It's crucial to acknowledge the significant authority held by the Chinese government. Once it intervenes in the rental market, ordinary citizens may face formidable competition given the government's substantial influence and resources. Allow me to provide an example to illustrate. Local governments have the authority to mandate that all public servants, employees in public institutions, and the staff of state-owned enterprises must rent government-owned housing if they seek accommodation. The rent could be deducted directly from their salaries, or units could receive a modest subsidy from their respective organizations. Implementing such measures is within the government's reach, and it can even allocate rental targets for various units. For instance, a particular hospital might be required to achieve a target of renting out 100 units, while another department must fulfill a target of 200 units. Therefore, when local governments transition into the role of landlords, this kind of approach becomes quite feasible. Although the government's properties are likely to attract tenants, it could spell bad news for ordinary citizens. In the future, individuals may find it challenging to secure tenants for their own properties, as the government has essentially monopolized the rental market. If people are unable to earn rental income from their properties, there may be an increased tendency to sell, contributing to a further decline in housing prices. If you find the previous explanation unclear, there is a broader perspective to consider. The future demographic trends in China over the next 2 decades. As we are aware, the number of newborns has been on the decline in recent years, contributing to an aging population. Many young individuals are embracing a more laid-back lifestyle, opting not to marry and have children. This shift is not solely a response to economic conditions, but also reflects a prevalent social attitude, perhaps even a trend. Despite current government initiatives in terms of promotion, encouragement, and policies, they appear to have limited impact on altering this trajectory. So, what can we anticipate in the next 20 years? As the baby boomer generation gradually diminishes, their children, the millennials, who are often the only child in their families, will inherit at least 2 or 3 properties from their parents. Even if these individuals can reside in the homes bequeathed by their grandparents, each urban family is likely to have 1 or 2 vacant properties without occupants. Peering to the future, the Generation X is increasingly opting not to marry and have children. In an era where nearly every family possesses vacant properties, if the government assumes the role of a landlord, will your house still command a good selling or rental price? With an existing surplus of houses and taking into account the anticipated decline in China's total population 2 decades from now, it's a matter worth contemplating. Let's revisit the central bank's policy. In this instance, the central bank has allocated a loan quota of 100 billion yuan to 8 pilot cities. How many houses can this sum actually purchase? Unfortunately, the funds are quite limited, akin to a drop in the ocean. These 8 pilot cities are predominantly second-tier cities with relatively high property prices. Let's take Zhengzhou as an example, given its prevalence of unfinished property projects and comparatively lower prices. How many houses could 100 billion yuan buy in Zhengzhou? Assuming a rate of 10,000 yuan per square meter, it would be roughly around 100,000 units. However, Zhengzhou has approximately 106 unfinished property projects, and over 200,000 families have acquired these incomplete properties. Thus, even if the entire 100 billion yuan is directed to Zhengzhou, it can only address half of the unfinished homes, not to mention other unsold properties. Additionally, there are 7 more cities sharing this 800 billion yuan. Therefore, the allocated funds fall significantly short. It can only be seen as an experimental endeavor. If expanded nationwide, the central bank's printing press might need to operate incessantly. Hence, I speculate that central bank has likely collaborated with local governments. The funds are primarily aimed at resolving issues with local city investment companies, ultimately assisting local governments in stabilizing their local debts. Other real estate companies facing insolvency might not be the central bank's primary concern. As long as local debts remain manageable, the reputations of local governments can be upheld, fulfilling the central bank's objectives. Finally, considering the banking perspective, let's explore an additional aspect for contemplation. Typically, banks evaluate the value of a property based on 2 dimensions, one being its potential resale value. However, for government-owned long-term rental properties explicitly designated as a non-saleable, attention shifts to the rental yield. It might not be widely known that when banks use properties like commercial space or offices as collateral, their assessment is more focused on the rental income generated rather than the potential sale value. The loan amount provided by bank is generally around 10 times the rental income. Therefore, in the case of government long-term rental properties, assuming a rental yield of 3%, even though 3% could be an optimistic estimate considering China's rental market conditions, the property's mortgageable value in the eyes of the bank would be around 30%. To illustrate, for a property the government acquired for 1 million, the bank would typically extend a loan of approximately 300,000. Yet, examining the special loans issued by the central bank reveals a requirement for banks to extend loans with an 80% loan-to-value ratio. A loan initially set at 300,000 is promptly increased to 800,000. Consequently, this essentially amounts to providing funds to the local government without taking risks into account. The central bank has earmarked the funds for this purpose precisely because banks are typically reluctant to undertake such high-risk transactions. I aim to illustrate the significance of the loan-to-value ratio, highlighting the substantial risk exposure inherent in the business. Banks, drawing from their extensive lending experience, have established a 30% loan-to-value ratio with a solid foundation. However, once elevated to 80%, the likelihood of these loans resulting in losses becomes notably high. In essence, this specialized loan serves as a gift to the local government, with a considerable chance that they may not even consider repaying the interest. Commercial banks already hold a significant volume of loans from local governments that have a history of not paying interest, and adding another potentially non-performing loan doesn't bother them. For commercial banks, given that this money originates from the central bank, the outcome of the loan has minimal impact on them. They won't directly bear the losses, so they are unlikely to be overly concerned. By now, you should have gained an understanding of the constrained repayment capacity of local governments. Essentially, the central bank's policy represents a covert form of fiscal deficit monetization, merely taking a different route and adopting a different guise. Anticipate more instances of this nature in the future, leading to an increased frequency of money printing by the central bank. This year, China's economic regulation leans heavily on fiscal policy, relegating the central bank to the role of a money-printing machine for fiscal purposes, signaling a considerable decline in its standing. Thank you for watching. Please leave a comment and subscribe to my channel. Just click the subscribe button right here. I'll see you again shortly. Until then, be well.